Can't. Okay, great. All right, great. I'm just going to share my screen. And tell me if everyone can see that okay. Can you hear me?
Yep, looks good.
All right, great. Well, good morning, everybody. I really appreciate you taking your precious time to sit with me today. Little introduction. As I said, I put the link to subscribe to my blog in the chat just for convenience for everyone in case you want to subscribe. Of course, I'm Chris Whalen, CPA. I run a full service CPA firm. We're business and individual tax experts. I've been licensed for a very long time. I'm actually a grandpa now. That's how old I am. But of course, I give a free consultation. And my motto is, if we aren't working for you, then you aren't working at your best, right? You're almost there, but you need to hire me to get to 100%, of course. So what makes Gloria and I so successful? Everyone asks me that question. Our secret is that we're available 25/8. That's what I always say. That's my secret. So now we have a cell phone rule. We all know what the cell phone rules are, unfortunately, but I don't stick to those rules. I tell everyone, turn your ringers up loud enough so you can hear them, because any call you get is more important than anything I'm saying, which is always true. I never mute my phone. It could be money on the phone, so I never mute it. One thing for self-employed people, in 2020, they created a special form, a 7202 form. That was a special coronavirus credit for sick leave and family leave for self-employed people. Now, if you were self-employed during those years, 20 and 21, you really want to check if this form was there, because there could be thousands of dollars of credit that were left on the table, and you want to go back and check. So that this was new for 2020. It related to coronavirus. This form should have appeared on either 20 or 21 return. If not, contact me, because this is a great credit. It's very easy to get if you are even single with no children, or if you had children, it's even a greater credit. So everyone take a note. I put this up top because it's very important and it's real money. See if you had this form on your 20 or 21 return. If you didn't, contact me so we can go over how much money you could have gotten, so then we can amend your return and get that money for you. The child tax credit is going to be dropping down from about $3,000 to $2,000 per dependent for 22. The reason why I bring this up is because some people have planned their estimates based on last year's credits. And so you might, if you have 2 or 3 children, there might have been $3,000 that you got last year. You're not going to get this year in a difference. So watch for this year. This might make you owe more money or get less refund than you think. So because the credit went down so substantially. All right, now this is a really important point. New Jersey real estate agents forever could not form an LLC or an S corp. It was a big mistake. People did it anyway, but it really was against your licensing board. So now you can, and everyone's excited about it. And so let me just talk about what does it really mean, so we don't make a mistake and jump into forming an LLC. So a sole member LLC files a Schedule C. And that's exactly what most realtors have been filing with their 1099, just like a sole proprietor. So there is no tax benefit to forming an LLC if you're going to stay a sole member one. That's very important. And people would think they want the limited liability, but most agents already have the E&O insurance covered by their broker. So an S corp, though, may give you tax benefits now, depending how much money you make. And that's a separate discussion. So you could learn more and you could schedule a meeting with me. Hold on a second. I don't see all of this. There you go. All right, great. And any questions about this, just put in the chat. Gloria, let me know, okay?
Will do.
Thank you. All right, so let's talk about the housing market. Is the housing market cooling? So this is a listing in Rumson I just passed by yesterday. So it's getting a little cool. So turn that off. All right, 1 second. There you go. All right. So are you prepared for the adjustment, right? We have a big adjustment, and this is also for ancillary people that work around the home industry, right? Doesn't apply to real estate agents only. All these people are affected. When housing starts going down, then all of these the mortgage reps, contractors, legal and accounting professionals are all impacted, right? So what are you doing this year to outdo the competition in your industry, right? We have this great coronavirus uptick. Everyone seemed like a genius, able to sell any house, right? So if you're simply going to use the planogram selling tools given to you by your managers, you may fail. This is the time to think outside the box, right? I think we're going to see a reduction in realtor, mortgage rep, and ancillary workforces similar to 2008-9. So let's do our best to survive this year and not be part of that reduction, right? Status quo may not work. So remember, home sales support everyone. I just wanted to put this graphic up to say that for every house that's sold on average, there's $113,000 of other impact in other ancillary businesses or professions. So every house we don't sell has a domino effect in the negative way to hurt everyone else that works around the industry. So let's get into some taxes right now. So on your tax return, most of us know you can either itemize your deduction or use your standard deduction, right? For example, a married couple can take a standard deduction of $25,900. That's almost double what it used to be. So a lot of people feel that they can't itemize anymore, but that's really not true all the time. So this could be a mistake. Many times charity and medical can take you over the standard deduction. So don't forget that medical and charity are itemized deductions. All right, so medical taxes, real estate, state income taxes, mortgage interest, HELOC, points paid for home purchase, charity, cash and non-cash. So all of these things you should be accumulating totals, because if you're close, especially, we can get you over that standard deduction number, because if we can have a higher itemized deduction, of course, it saves you taxes. So that's what we're shooting for. We like to do itemized instead of standard, right? So I wanted to give you this here. This shows you different filing statuses, so you know what number you're looking to get over. This is for every different status here, that you might be single, had a household separately. What is your number for standard deduction that we're looking to beat? Now, one of the main things that people miss is charity. A lot of people are afraid of charity because they can't get a receipt for everything, so they avoid it. But that's a bad idea. I did a lot of research on this, and I came up with a chart to give you guys an idea. Well, what's a normal amount of charity to take? Because I get this question here all the time. Do the charitable contributions trigger an audit? Okay, the answer is no. But I wanted to, so everyone take a look at this screen here, this little chart. And I want you to notice the income ranges on the back, on the left side, and what their average charity is. And look at the right side. It shows you that the more money that you make, the more you give to charity. That makes sense. You see, you start at 4%. It goes down to people making $1 million. 94% of them are giving to charity every year. Now let's look at the middle column. This shows you the average cash charitable deduction they take. So this is the 50% average by income range. So let's take a look at 100 to 200,000. So they're averaging almost $4,000 of cash charity. So you guys should be thinking of this too. I'm sure when you go to buy Girl Scout cookies, you're buying 1 million of them. When you go past the Salvation Army bucket, you're putting in all your change all the time. So this is something to remember, that look at these figures. If you're $200,000 to $250,000, you might be up to $6,000 the average. So taking a charitable deduction might put you over that standard deduction limit. Don't avoid it. Don't be afraid of it. It's something to talk to me about, what's reasonable. And then also, everyone should also be taking non-cash charity. Everyone's donating things almost every year, bags of clothing, old books, old furniture. So every year you should have a non-cash also. So all that can also help to put you over your standard deduction. So don't miss this. Do a little homework on it. Any questions, of course, call me. We can look at your numbers and talk about what's reasonable, okay? This is Accounting 101 for business owners. I'd like to go through this and bring you up to date. I know there's more people on here besides real estate agents today. So first question, do I need to pay estimated taxes? For some reason, real estate agents don't like to pay estimates all the time. Now, I know that's because you have cyclical income. Why would you pay a first quarter estimate in April when you haven't had a closing in the first quarter? I agree with you. So someone like you that has variable income streams, we should be paying estimates when we get a commission check. That's what I try to set up with my clients. So here are some questions. Did you owe taxes with last year's return? Then the answer is yes, most likely. Did you earn more money than last year? Then most likely you're going to owe estimates or more than you thought. So if so, most likely yes. Remember, you cannot wait until April 15th to pay your taxes when you're self-employed. There are high penalties if you don't pay as you go. Again, you might not do equal quarterly estimates because of your variable and cyclical income, but when you get money, that's the trigger that you owe tax. So always consider paying money immediately when you get a commission check. You can always call me to see, well, what percentage should I pay, right? What percentage federal and state should I pay? By looking at your tax return, especially if I did it, I can tell you exactly what to do. So pay quarterly or pay on time when you get paid. Big question I get, you need to keep your business records for 7 years and any tax supporting document. If it has nothing to do with your tax return, I don't need to keep it. So if you have a bill that's not related to, like a water bill at home, something like that, if you take a home office, you need to keep that though. So 7 years is the rule. After 7 years, we can shred it. Now, this is a very important point for self-employed people of all kinds. I tell everyone listening, there's no one that's listening that uses the same personal account for all their business transactions. So no one here is commingling their business and personal transactions. Of course, I'm being facetious, but if you don't have a separate account, please make a separate account in your name going forward and put all your income in there, pay your expenses out of there, and pull your net into your personal and pay your bills there. The reason why I say this is because if the IRS starts asking you questions, the first thing they're going to ask for is copies of your bank statements, your business bank statements. If you put everything with your personal, you have to show them everything. I know this seems like a pain in the neck, but it's really helpful at the end of the year, one, to help you keep track of your accounting for your business. Imagine how simple it'll be if every transaction in that checking account or that credit card is business. We know we have to categorize all of them. We don't have to worry what's business or personal. So this is a great trick, and I know it's a little more work, but it's so helpful in the future on a number of levels. Home office deduction. Remember, every realtor and most people that are self-employed have a home office. Now, many are afraid to take it. Almost every realtor that I get as a client, a new client, does not show a home office. And that's terrible, right? It doesn't reduce your basis. And does your tax return reflect the home office? I can send you a worksheet how to develop the numbers to take a home office. It's pretty straightforward. But remember, and you can send me an email and request that. So remember, a realtor, especially your office is not the broker's address. Your office is your home office. So the moment you step out of your house, you're traveling for work. So remember, that is where you work, and you happen to go into the broker's office every now and then. So don't be afraid of home office. Anyone running a business, even if you have a corporation or a partnership, you should also be making sure you take a home office deduction on that return to give yourself a credit flowing through. A lot of owners of partnerships don't do that, but or S corps, but they really should. All right, what can we deduct? Now, don't limit any payment that you make that relates to your business can be deducted. That's important to remember. But some are a blend of personal and business. So what I do is, so for example, I still have 2 of my children on my cell plan. I go on each month. I pay a third with my business, and I pay 2/3 with my personal. Perfect. Cell phones with family. Same thing with Easy Pass. The important thing here is that if you have something that's blended business personal, you always want to pay it through your business all the time, because at the end of the year, it's much easier for me and us to talk about what we need to extract as personal. If you pay your Easy Pass in one account over here and your cell phone over here, it makes it a lot harder to grab your info. So if it's partly business, partly personal, no problem paying it through the business. We can analyze it together later to make sure we only take the business portion. Same thing with credit card charges. Canceled checks are very important. We don't write that many, but we need them. You need to have a copy of them every month when you download your bank statement. I urge everyone to make sure that your bank is giving you copies of your canceled checks with your downloadable bank statement. A lot of banks are saying, no, we have a portal, click and print them, but that goes away after 90 days, and that's not a, and and that's not again, that's not feasible or practical. The IRS is going to write to us 2 or 3 years from now, and those checks are gone. All right, online bank storage is not enough. All right, so let's talk about let's talk about let's talk about the auto expenses. So now I get a lot of questions about this, and there's a lot of confusion. Do we take actual? Do we take mileage? Right. So the higher the mileage, usually the mileage method is better, and I'll go over why. In the first year, though, when you place a vehicle in service, we check which is better, your actual or your mileage, and then we make a decision that we must elect and use it forever. So once you make an election for a car, you can't suddenly change it later because the benefit's going to be better. Because the benefit's going to be better. And now remember, whether you lease a car or buy a car, the mileage method, you have to keep track of your miles. And people that lease a car don't understand that, but it's true because we still have to see what the business portion is. But lease cars can also use the mileage method, but mileage logs are required with both of them. And this is a big problem where clients don't keep track of this. If the IRS is going to bother you, if the IRS is going to bother you in a few years, they're going to target your largest expenses, and that's mileage and travel is one of the main ones. And if you don't have the detail they need, they're going to add that back and charge you tax and penalties and interest. All right. One other important point here. Remember, tolls and parking are always separate from whatever you do with your car expense. A lot of times people think when they use mileage method that they can't take their tolls. It's always separate. So always give me that. And parking is always separate too. That's a very common mistake. Here's the mileage rates in 22. Be careful if you do your own taxes. They split the year. So you're going to have to do a special form to split the mileage that you had between these two rates. And here's the much larger rate due to inflation that we're going to get for 23. And that's a pretty large number. That's 65.5 cents. So mileage logs. Many of us don't keep track of our daily travel, but as I said, under audit, the IRS is going to look for this and they can deny it without the proper proof and support. So what can we do? So what are the basic rules? No estimates are allowed. We need the exact mileage. Each trip has to be itemized, and the mileage totaled annually. I know this seems onerous, but I can give you some hints and tricks that will help you to do this without it being too much work. I show this every time I do this presentation because I wrote the IRS about 20 years ago, and I asked them, what do they have in their records that shows exactly what they want? And we can look how ridiculous this is. As you can see, they want to start and stop odometer reading every time you get out of the car. So if you were showing 5 houses today or making 5 stops in your business, you would have 5 lines showing your odometer every time. So we can't do that. They don't really expect that, but I'm trying to show you how detailed they are.
Chris, I have a question regarding if you purchase a car that you leased, can you change the method you use for mileage?
Well, the purchase isn't a lease. So you mean she leased the car?
Yes, and then purchased it. They leased it and then turned it over. I mean, at the end of the lease, purchased the car.
Yes.
So the question is, can you change it at that time?
Yes. When I consider that placing something in service new, and then we can make all new decisions about it.
Okay. I have one more question, and this goes back to the deduction. Somebody had asked, what is the opinion on dry cleaning expenses?
You can't take dry cleaning expense. Only entertainers can.
Okay.
Technically.
Maya put in the chat, looks like Mile IQ is an amazing app that you can mark each drive, personal or business. That's
yes, I'm getting to that, and that's great.
Perfect.
You're right in sync with where I am. It was Maya?
Maya, yep.
Thank you, Maya. So what can we do to comply? We have mileage apps, which Maya's right in perfect sync with me, right? So, but they're not enough. Mile IQ is great because it'll let you swipe and say some travel was business. That's awesome. So we need that. That's great. But remember, it doesn't give us a lot more information. We need the exact address. We need the client involved and the business purpose, right? So what you want to do as an adjunct to MileIQ, you want to make sure you simply have every address you're going to during the day in your calendar. It's not too much work. Make a different entry for each one and put the client name there also, because that along with your MileIQ will sync perfectly, right? Think about it. If I have your MileIQ for Tuesday, January 2nd, and I have your calendar, they should sync up really well. That's the beginning of great proof. So if we have both of those and to present, I have all my total miles for business. But one thing is missing. So you simply add your destination to your calendar with your client name, print out the monthly reports and save. If you have both of these, you're 99% there. But one thing that's missing, the beginning of mileage method, the beginning of tracking your miles is total miles. Remember, so it's not just your business. So you can do the MileIQ in the calendar, but by law, you're supposed to have total. So how do we do that? We can't just go to Jiffy Lube and say, I got my oil changed in March and try to estimate. And we also, writing it down is okay. But what I do is I send out a blog post on New Year's Day where I say, take a picture of your odometer. That's a really good proof with a date stamp. So I get hundreds of pictures every first of the year that I archive for my clients. So that gives us everything. We'd have beginning and ending miles. We know the grand total. You've kept the MileIQ. You've kept the calendar, which is not too much work. You need to know where you're going anyway. And then I can present all of these things, and then we can substantiate to the IRS what your travel is, and there'll be no change and no tax or penalty. Hope that makes sense to everybody. All right, so that's great. Amount of mileage. So get on my blog list so you get reminded to take a picture. And again, some clients don't do it. I don't know why, but I think it's a good idea. So try to make it a habit. This is very 2021. Meals used to be 50% deductible. They're now 100%. Now a meal is a sit-down dinner, lunch with a client for business purposes. Now, a meal is not if you make a presentation somewhere, if you're a business owner, or do an open house or something like that as a realtor, that's marketing expense. That's never meals. That's a marketing expense. Now, the difference here is that entertainment is no longer deductible. So entertainment separate from meals are tickets to Atlantic City, hotels, Broadway shows, Yankee tickets, things like that. Those are not deductible anymore at all, but meals are 100%. So remember that. Some people make the mistake of thinking meals and entertainment are all excluded now. That's not true. I get a lot of returns when no one took meals last year because people didn't know exactly what they were doing. Okay.
Chris, I have a question that came up. It was, if you finance a new business car for 5 years, can you depreciate its value each year for 5 years to reduce taxable income? So I guess the emphasis would be on financing the car.
Yes, remember, this is a really good point. When you finance anything, right, it's purchased by you. The financing doesn't matter. So same thing with a credit card. I could have $1 million of credit card expenses or things paid on credit card at December 31st. I can take them as a deduction because I owe the money on the other side. So the financing doesn't matter. And so remember with depreciation, sometimes people buy a truck and that could be immediately expensed through depreciation. Or yes, if you have a passenger vehicle like an E-Class, that would be depreciated over time. So the depreciation has nothing to do whether you paid cash or whether you financed it. All right?
Great, thank you.
No, you're welcome. Great question. So gifts, everyone should raise their hand if they give gifts in business, but we don't give a gift in business. I never have gifts in a tax return because a gift is something different than really your marketing. When I give a Home Depot gift card to a client at a closing, that's marketing expense. If I knew I would never get any business out of it at all, I'm not doing it. So it's a marketing decision. So don't ever have gifts on your return because really, if you look at the IRS definition, it doesn't even apply. So put it to marketing or advertising, as I always say. My clients know that already. And that makes you think of people avoid giving those what they thought of were gifts because they think it's not deductible and they're missing out on marketing opportunities. So now you don't have to have this there was a $25 limit. Everybody thought about giving a gifts to one person per year, but now don't worry about that, right? And we can You can spend more money in that area, and know it's fully deductible now. Now, remember, for self-employed people, we still have tremendous retirement deductions available for you. Solo 401k and SEP IRA are two of them. They're 100% deductible for yourself, and it's one of the best deductions you can take still. So please consider putting your money away for retirement. My clients know when I do your return at the end of the year and send you a draft, I include a whole section on what your SEP IRA deduction could be and how much tax you can save. Let me give you an idea. So to do a SEP IRA, you can use 25% of your net Schedule C. So let's say that's $25,000, right? So you can immediately deduct that. If you're in a 20% bracket, think of all the money that saves. So you're really putting away 25,000, but you're saving 20% of that. All right. And so we have $5,000 that you're not paying in tax. So you're putting away 25,000, but it only costs you 20. So there's no better investment than that. There's no better return on that. So if you're not thinking about this or your account is not pushing this, please talk to me about it, because it's one of the best deductions that self-employed people have over W-2 people.
Chris, I have two quick questions. One was regarding the gifts. Do they need to be branded?
Absolutely not.
Okay. And the second question is, entertainment can't be considered advertising?
Well, it depends on what, if you're bringing a client to Atlantic City and paying for a room at the Borgata, no.
Okay, great. Thank you.
I know it doesn't make any sense, because I think that all was a failure of the hotel lobby. I think about it. That's who it hurts. I have plenty of clients that would send clients, to Vegas for a weekend, do a quick trip to the Bahamas, so the travel and hotel industry, their lobby failed. I couldn't believe that happened. And so, but no, you have to be careful. But if you're in the middle on something, always call me immediately. Give me a text. Everyone knows I'm looking to help. And especially everyone here, if you don't have a CPA on call, if you have questions, if you have a sitting with a client, and if I can any way help you solidify that deal or make you look good by saying that I'm your CPA on retainer, make sure I'm in your phone, because I take calls like that every day. Even if you're not my client, I'm looking to help everybody. And of course, it leads to business, but I'm always available to help you to clarify something with your clients to make them look, to make you look good.
Okay, is it too late to do a SEP IRA for 2022?
No, absolutely not. So that's the other good thing. A regular IRA would be due April 15th. Okay, so 2022 regular IRAs are due April. Even if you extend your return, it doesn't matter. You can't go further than that. The SEP IRA has good rules, and the rule is you don't have to. You can wait to pay your SEP until your return is filed. So if you could see my office, I have all these folders to my left that a lot of clients, you would see them during the year because they don't have the money for the SEP. So let's say in my example, it's March 15th, and I told you, hey, Gloria, you can do a $5,000 SEP. It's going to save you a $25,000 SEP, but you don't have the money right now, especially a lot of people, their income is light in the first quarter. So what we can do is we get your return ready. We pay anything we need to pay, and we put you on extension. And so technically you can pay into your SEP IRA through October 15th of the following year if we put you on extension. So plenty of leeway. It's tremendous that you can do it that late into the new year. So there's really no excuse, at least to try to, again, I push this so much because it's one of the best deductions with real tax savings that a lot of people aren't saving for. Also, let's say you get on the program to do a SEP. Well, you could put money in every month during the year and bank it just like other savings. That's also a good idea. So Gloria, you were going to have 25,000 at the end of the year to pay for SEP. Maybe you could be putting 1,000 away every month. So we got 12,000 in the bank. So when tax season comes, we could pay the difference. All right, does that answer the question, everybody?
Yes, that's great. Big difference between SEP IRA and a regular IRA. Are you being penalized if you need an extension? Does it cost anything? They've never done it before, but they're curious.
Absolutely not. But the most important thing that everyone is not taught is that it's not an extension to pay the money you might owe. It's only an extension to file the return. So that's why if you are going to go on, that's why we just talked about, let's say I was doing Gloria's return. We get it 100% ready and done. Let's say she owed $500 with the return to federal. So we pay that with the extension. So by the time we file Gloria, let's say in August, Gloria has paid her $25,000 in the SEP. She calls me, hey, Chris, get my return done, get it e-filed. So she'll have zero due if we did everything right. So yes, no penalty for an extension. There's no audit risk from an extension. Don't worry about all of that. It's a great tool to use. I do hundreds of these a year. I've never had one of them audited at all this is in 37 years. So it's a good tool. Just do it right. Remember, just like the estimates have to be paid on time, not to go on about that too much, but your tax needs to be paid April 15th. So if you do have another preparer, you're doing it yourself, make sure they're calculating any possible balance due. I know it could be a rough number, and pay that with your extension, okay?
Got it. Is it too late to start the S Corp for 2022?
Yes.
In other words, it is. Okay.
Well, not necessarily. There is a revenue procedure that will let us, the problem is it's not formed in the year yet. It's if it was formed before, if it was formed in 22 to be a little easier, just have that person give me a call so we could talk about it separately.
Okay, perfect.
That, I would love to help with that, but I always like to be honest about what's possible.
Right. I'm going just quickly through some of these. Can you deduct 2 vehicles used for business or only 1?
Yes, I can deduct as many as I use. I have 2 cars. And of course, I just keep track of the mileage the same way, right? So one might be 1,000 miles a year, and one might be 10, 20,000 miles a year, but sure. And then on the tax return, we simply have 2 vehicles listed and we put the information down. So that's why having the mileage method, remember, the higher the mileage, the better. So if you use the mileage method, it's very easy to show 2 cars.
Perfect. Any suggestion for writing off entertainment?
Is that the same person?
Nope. Different person.
Writing off entertainment? You mean, like, again, you can't take hotel rooms or things like that. It all depends. Have them give me an example in the chat of what they're talking about.
Okay, like tickets and country club.
No, country clubs and tickets to sporting events or concerts is not deductible.
Okay. Okay, this one, what about a simple K? Somebody asked.
You mean a solo 401k?
Just says simple K. I'm not sure what they're referencing.
Right. Well, if it's I'm looking here, right? If it's right, yeah. Yeah, well, the solo 401k is very similar to a SEP IRA, but remember, we don't know what that number is until we do the tax return. And then there is some benefit sometimes to a solo 401k as a self-employed person, but we look at that when we do the return, what might be better. So it's really a discussion to be had. I don't know what those benefits are until I have the actual tax return done. But like I said, at the time, we go over all the benefits of either one.
Okay, 2 more quick questions. Can you write off a home office if you're renting?
Yes.
Okay. And can you talk about LLC versus S Corp in more detail? Why choose one over the other? I don't know.
I just don't want to take too long. Well, Gloria, can I take the time and talk about it a little bit?
Absolutely. Oh, yeah.
Okay, great. So is everyone looking at my slide, or are you looking at the gallery view? What is everyone seeing right now?
Slide. I can see your slide.
All right, great. So that's okay. So let me explain. As a sole proprietor, let's say you make $100,000 on your Schedule C. Remember, there's self-employment tax on that, and everyone knows that's a lot of money. But where does it come from? Well, if we think back to when we were a W-2 employee, everyone has Social Security and Medicare withheld on their pay stub. Now, those 2 things are FICA, and that's 7.65%. So now people don't realize that your boss at the time had to match that. So that's 15.3%. So that goes to the government out of every dollar. Now, what happens when you're self-employed like us, we have to pay both sides of that. So let's say you made $100,000 W-2 you would have had $7,650 withheld in FICA, and your boss would have matched that, giving you $15,300. When you're self-employed, you would pay $15,300, both sides of that. Okay. So now where does the S Corp come in? So depending how much money you make, the S Corp is used to try to save some of that FICA. That's the idea. So let's say we have an S Corp now that makes the $100,000 and not your Schedule C. All right. So we can give you a $50,000 W-2 out of the S Corp and give you a dividend flow through of $50,000. So your taxable income is the same, but your FICA taxable or self-employment taxable is half. So in that case, if you think about it, you would save $7,650. Does that make sense to the person that asked the question? Everyone understand that?
Yep.
All right, great. But you have to be careful because there are rules with the IRS about what's reasonable compensation. So taking 50% of that as wages might be a little low. But the more money you make, the more it could make sense. So that's more a discussion to see how much you're making. Because remember, if you are an S Corp, you now have to do an S Corp tax return, which is more expensive than just doing your 1040, sometimes much more expensive. And you also have to do payroll for yourself. So you want to watch how much money you make. And if it's worth it, like I said, we're going to save, in my example, $7,650. But and that would be worth it. Your costs in tax prep are not going to be that high at all. So if you're making 100 grand or more net, not gross, then it could be worth it to elect S Corporation going forward.
Perfect. I just wanted to mention that in the invites that I had sent out, I have Chris Whalen's contact information. So you will be able to contact him directly after this to get some of these questions answered. And so what I'm going to do is, quick question, can you fund a SEP and a Roth in the same year?
Usually you're going to max out the one, and the answer's no.
Right. Okay. And how do you fund the S Corp if commission has to be paid to individuals in New Jersey?
How do you fund the S Corp?
Yeah, I guess the way I'm reading this question is that because they can still only be paid as individual, the real estate commission gives us the regulation on being paid as an LLC. They're getting paid as an individual. How are they putting the money into their S Corp?
Yeah, well, now that the rules are changing, you would have your checks written to the LLC or S Corp from now on.
Well, that can't happen yet. It's at least 6 months out right now. We're waiting on the real estate commission on that. So once that happens,
I think it's going to happen. So I'm betting on trying to plan. I can't wait till the fall to plan for these things. So so people I've talked to, I believe it's just a matter of formality for them to sign it. So I would, if you wanted to do an S Corp or an LLC for some reason, I think you should plan on doing it just so we're ready now at the beginning of the year.
Do you have a lot of people using the S Corp? Realtors?
I probably have 15 or 16 people right now that I'm going through the process of forming an S Corp for them.
Okay. And does it increase the audit risk for realtor?
No, not at all.
Okay, perfect.
In fact,
we'll continue on.
But the question, that audit risk question is good. So let's think about it this way. Let's say I make 500,000 gross in my business, and I'm a Schedule C for years. Suddenly, I'm an S Corp now, making 500,000 gross. So it brings you from a large Schedule C risk to a very small S Corp risk. Think about it. In the pool of Schedule Cs, that's a high gross number. In the pool of S Corps, it's a lower number to make that person feel better. Does that make sense?
Yes. Perfect.
Okay.
All right, great. That's all caught up.
All right, great. Wow. Okay. All right, so let's go. So now I'm going to talk about, this is for everybody, especially realtors, but everyone else who might be thinking about how they invest their money. So which investment is safer? It's a tale of two investments. Don't be scared. It's not that spooky. So I'm going to show you investment A and investment B. And what I'm going to do is go down here with attributes of each in different categories. It won't take long. And I want you to get an idea of how safe each one is. So let's say First one, I'm going to compare the attributes, like I said. So the first one is very volatile, unstable values. The second one is stable values. We have valuations not based in reality with investment A, and in B, they are really based in the market and reality. I can't hold or touch my investment A, which would bother me, and investment B, I can. Investment A, many things are out of my control that impact the value of my investment A, but it's the opposite with investment B. I have wide swings of gain or loss in investment A and small in B, and I have no scientific way to estimate future value or cash flows with A, and I have future values and cash flows can be accurately predicted. Now, if we look at this list, it's a very honest list. I have a lot of experience. I'm a professional. Investment B seems a lot better. Don't we all agree? That investment B, I would never invest in investment A in my life, which I don't. And that's because it's the stock market versus the investment properties. So even realtors I talk to, I do seminars for so many of them. I always say by a show of hands, how many of you know that investment properties are a better bet than the stock market? Hardly anyone raises their hand, even though you sell the product. So it's always better. Real estate is always better than the market, even for more reasons than this. I urge agents to have this printed out at their desk so they can talk to clients about it. Because clients, remember, the reason why there's fear of the stock market is all propaganda that was espoused by all the big brokers. Because remember, Fidelity and Goldman do not make money on real estate. They want to make that point on all your investment money. That's why it's demonized. So I can argue this all day long. I've never lost this argument with anybody in 37 years. So here, I believe that investment property market is ignored as an investment property strategy by almost everyone, and it's due to vague fears and misunderstandings. So if there's anyone anyone, if they could put in the chat, who before they saw this thought that the stock market's always safer than real estate. I'd love to know if anyone thought that, and if I changed their mind at all. All right, so this is for real estate agents especially. So if you're a Monmouth Ocean County realtor, this is where you've been selling and everyone has been doing great, and suddenly we're not doing so great. Inventory's down, sellers still are unrealistic about pricing. We all know that. So this is cutthroat. This is the cutthroat area, and I would be thinking outside the box, right? I would be thinking of investment property strategies, and what I tell realtors is we could be 50 miles outside the border of New Jersey, and we could be selling investment properties all day long, and it's a lot less competition. So it's frustrating for me because a lot of realtors just stick with wanting to sell forever homes, even when we have a problem with the market in that now, when there's so much opportunity here, right? So how many of you have emailed your existing residential clients with investment property opportunities? And usually the answer is none. I mean, I get tons of letters and email feed from hundreds of realtors. I haven't seen one in 6 months, right? So this is a perfect time to tell them to divest the gains and diversify into hard assets, namely real estate. Clients mostly in stocks and bonds are at risk. Remember, bonds and stocks can't really hedge each other the way they tell you. It's one small bubble of investment. If everything is there, you're very much at risk. At least pull some money out and diversify into hard assets. Here's an email idea. Subject line: why stay up at night worrying about the Dow Jones? Call me so I can show you how real estate investments can help you sleep at night. Real estate beats the stock market in every measure, right? So I hope you all found this worthwhile. Email me your contact info and subscribe to my blog. Are there any questions?
Okay, I think I had two more. Hang on one second. Regarding
I'm looking too.
Yep, regarding the S Corp, are we issuing a new corporation or just filing our LLC as an S Corp?
Right. If you have an existing LLC already, you can do an entity change or classification change to make it an S Corp. So you don't have to form a new company. But if you're going from scratch and you know it's going to be an S Corp, go right to S Corp. Don't do an LLC.
What percentage of home internet can be claimed?
Well, what I do is it all depends on your percentage use. So remember, when it comes to home office, it's very important. Everyone gets bogged down in what percentage am I using exclusively. So don't worry about that at first. Just do my worksheet or keep track of every item in that house, maintenance, lawn, roofing, anything you have done to the house, because we're going to grand total that. Then we talk, including home internet, home phone, things like that. Then we talk about what exclusive use is. So don't get bogged down. And remember, if you do have an exclusive area in your home that you use for business, though anything you do to that area is 100% deductible. So that's treated like a full commercial space for you. So if you do blinds, wallpaper, a lot of people are fitting up that room because they're doing video. So if you buy a desk there, so remember that's 100% deductible. Include that as a regular schedule, so your business expense, and don't put it with your home office worksheet.
Which brings up a quick question on if you, where would the cutoff be for the agent and for the agent's taxes that you do with regard to, let's say, furniture? Should they capitalize that or expense it, or Section 179?
Anything they buy, anything you buy in the house, are you saying exclusively for your area for business or the whole house?
I'm talking exclusively for the home office. Let's say
Yes,
you buy
yes,
a desk, that's
so imagine a
1,500.
home office is a separate space you're renting. All right, so I have to do that as a trick in my head. So all right,
Yep.
so you would never think of it as home office related. You would just pay it 100% out of the business account. Perfect.
Right.
And then
Right.
it becomes a full 100% deduction on the. So right, if you buy furniture for that room, carpeting, any draperies, things like that, it's all, and computers for that room, anything to do with that exclusive space is 100% deductible.
Okay. Somebody else wrote syndication, Texas, Florida, ?
So can I have let's see. I'm looking Judy, I know
Judith.
Judy. So Judy, so what's the specific question?
Well, in terms of real estate investments, do you advocate syndications where you can be hands off but still get some deductions?
Oh yeah, there's no doubt. Even if you're if you're a partial owner, I'm still taking all those deductions prorated based on what your ownership is, right?
Right. Okay.
So no, that's
Do
still
you
right.
like syndications?
Say it again.
Do you like syndications?
I like syndication only when it serves the purpose, right? Sometimes, like, there's people that don't necessarily want to have as much hands-on, right?
Mm-hmm.
So I love all real estate investment as long as it's done right and I can review all the contracts and my clients are protected. Right? Sometimes clients emotionally jump into things like a syndication deal, but they don't read the fine print. So I know I'm not a lawyer, but a lot of the deals you sign, there's a tax component, right? Sometimes so I should always be reading that tax component of a contract or a syndication, or when you're getting involved in a REIT, for example.
I'm thrilled with that because I didn't know how to assess it myself.
Well, fantastic. Well, thank you, Judy.
Great.
And if someone said, can I repost the email idea? So Kevin, I put my email, just send me an email. I'm going to put my email again right now and just ask me in the subject to send you that email ID. Okay. And remember, well, let's just talk about the real estate investors quickly. What do they remember? That's a totally different sale. My forever home sale is totally different. Remember, investors don't care about cul-de-sacs, technology, granite countertops, school systems. They don't care. They're looking at the bottom line. The one good thing about selling real estate for investing is that they don't care if it's going up in value. Can you imagine if you don't have to worry about that selling real estate? Because most of my clients, they're never going to sell it. They're buying it for the pension replacement, which is what it really is. That's a whole separate seminar on how my system is used to replace the pensions of old like my dad has. So I hope that answers that question.
What are the implications when you sell the home where you had a percentage home office?
Great question. Now, remember, that's always a concern. I did mention it in my slide that when The only time you can have an impact is when if you've depreciated the house within the home office deduction, right? Basis reduction depreciation. But most times we don't do that because the number is very low, right? So most times that's not an issue. Your home, remember, think about it this way. It has nothing to do with the basis of your house. You're being reimbursed for your out-of-pocket costs, right? You are paying for all the space in your house and all the maintenance, and you no longer can use part of this for personal use because your business is using it. So just as if you went to the store, the post office, to buy postage with cash, you'd reimburse yourself. So that's the logic of what you're doing. It has nothing to do with basis. It doesn't affect your gain, again, unless you've depreciated, and most times we don't do that. All right, so that's a very good question, and everyone needs that clarified because people avoid the home office thinking that whole deduction is going to impact their gain later, and it's not true. Okay, so can I read the next one about the individual investments going to an LLC? That's the next question.
Sorry,
That's
Chris, I lost you.
Kimberly, can you hear me? Gloria, can you hear me?
I can hear you. Can you hear me?
I can,
Yes, I
great.
can hear you.
So Kimberly, great question. So first of all, remember, there's a lot of misunderstandings about LLC. Everyone thinks they can get an LLC, then go run people over. I don't know why they think that. I'm free and clear. But what's happening is, even if you have an LLC, if you're the landlord person, right? Gloria owns a rental property and she failed to fix the sidewalk, the LLC doesn't protect you. So the most important thing with rental properties is to have insurance.
I was recording.
I only invest in real estate. I only have maybe 2 of my properties that are in LLCs because I'm in a partnership with someone. I don't have any of mine in LLCs. I have insurance, and I have a personal umbrella of insurance on my home. So remember, the most important thing is that you want legal fee insurance is what it is. If you have the right, I haven't had one client in my whole career that had the proper insurance on an investment property that came out of pocket for a penny. So yes, an LLC, sometimes it's helpful. There's different strategies, but remember, there's no tax benefit. Sole member LLC owning a rental property, you'll still file that as a Schedule E on your tax return, similar to a sole member LLC filing a Schedule C. So it does, the thing the LLC protects you on is agency. So if you have an LLC and you have a property, if you send a contractor in there and something happens with them, then you're protected from that. So but that rarely happens. So there is a protection, but not what people think. So just have the right insurance. If it makes you feel better to make an LLC, but remember, the banks don't like to give mortgages to LLCs. So normally you got to put it in your name and then move it to the LLC anyway. And that's always a good conversation with me when you're thinking about it or getting close. Chris, what should we do? So don't worry about making an LLC. Find the right property, get the right deal, close on it. Then we could always move it to the LLC anytime. Okay?
Thank you.
Thanks, Chris. My computer shut down, so I had to move. There's one last question here. Did bonus depreciation drop to 80% this year?
In 20, I have to look that up to make sure because it's based on the class. So Eddie, if you could send me an email and give me that question, I'll definitely answer that for you today. I just want to make sure I check the different asset classes because bonus depreciation affects many different things. I just want to give you a clear answer.
Perfect. Does anyone have any other questions? I think we've covered everything in the messages.
I helped out Paul Vierick the other day, right, Paul?
Yes.
Yes, you did.
Perfect. That was the 1031 exchange. On investment property, have typical insurance, but then add a personal umbrella on primary residence?
Right. I have a $2 million umbrella personally. I have my professional liability like you guys have. I have my commercial liability, but it's always good if you're in business. That $2 million is so cheap. It's only a couple $100 a year. And what it does is it covers you for anything that's not covered. You have a car accident where your limits aren't meeting what you need. It's right there. You have a business liability. It's there without a problem as a secondary. So, so if you have a home, look into your homeowners, call them and see how much it would be to add $1 million or $2 million. It's well worth it. Then you should have all
Yeah.
peace of mind for any LLCs or any homes you own, things like that.
Perfect. One last question. So it doesn't make sense to do an LLC if you net under 100K?
Well, it's the S corp. Well, it doesn't It doesn't make sense to do an LLC if you're a realtor or you have insurance already, right? Because your liability is protected. So if you're a realtor and you're making under 100,000 net, right, it might not be worth it to do the S corp. But 100,000 net, it could be worth it. But just be careful, because I know there's a lot of unscrupulous lawyers out there that know everyone's excited to possibly be an S corp, and they're not really looking at your numbers. So everyone knows I'm measured about it. Let's look at it. I want to give you objective. So always give me a call. Maybe send me your tax return for 21. Send me an email and say, Chris, I was on the Zoom, whatever, on the Google Meet, and we'll look at it together and we can have a conversation without a problem. I like to see things that, give me some data, like Paul, right? I asked Paul the other day to give me more information so I could give him a good, clear answer. So I'm not putting you off. I just like to be effective and based on the reality of your situation, because everything's different. Can I mention something about a 1031?
Yes.
Okay, 1031, people get confused about it. If your client or you as an investor in real estate, if you don't need the proceeds from the sale, right, then we can consider a 1031. Any money you take into your hand will be part of your gain. So remember, you can't come to me after you sold and say, let's do a 1031. It's too late. Remember, we have to sell the property, and at the closing, we have a special, usually an attorney that's an exchange agent. So let's say you have a $300,000 profit that goes to them, and it's held in trust. You never take the money. They bring that to the next closing when you buy. Okay? And so we have that. So you always tell your clients, we can't take a penny every penny I take is going to go to gain.
Perfect. Anybody have any questions? Any additional? This was awesome, Chris. I will resend out your information in case anyone needs to reach out to you. And any preference on the subject line so that you know it's coming from here?
No, if
Just
you want to
topic.
put Gloria's name first, Gloria Monks, and then a hyphen, that would be great.
Okay.
And here, I'm just gonna put this up quick. If anyone wants to take a picture of the screen, all my info is at the bottom.
Perfect. That's great. That's a nice, easy email. Chris Whalen, CPA at gmail.com.
And that's where I am all the time.
Awesome.
Well, I can't
Yes,
tell you how much I appreciate everyone coming. I try to be as effective as possible. I know I go to presentations and I'm like, why am I here? So I try to make it detail and things you can use in your business. And again, subscribe to my blog. It's really worthwhile. I promise you. You can ask my clients who are listening right now. Anybody have nothing else? If anything else, send me an email. I'll get back to you right away.
Thanks so much, Chris. Thanks for being here today. And thanks everybody for coming. I'll talk to
Thank
you all
you.
soon. Have a great weekend. See you guys.
Thank you.